No doubt you've really been seeing a lot that's been going on with the stock market, the economy, the bond market even. Those are things that we are expecting to continue, this volatility. And it really started right around November of last year, of 2021, and that has been progressing slowly through the first quarter of this year, and now is really picking up speed. This economic instability, this instability with the stock market, the bond market, and that's all perpetuated by inflation. And what I have been saying for the better part of a number of months now is that this is an environment that we need to be taking less risk. You see, when the Federal Reserve comes out and says we need to be fighting inflation at all costs, which is what we are looking to do right now, that is basically code to say that they're going to be doing a lot of things with respect to taking away the money that's been printed over the course of the last number of months, years. And that is a huge deal when it comes to the economic stimulus that we've been having over the course of the last couple of years. So what's happening? What has led up to this point where we're taking a look at yesterday, Monday, June 13th, as a huge deal that wasn't even basically priced in as of just even a week ago with the stock market and even the bond market, was the fact that we're anticipating increasing interest rates more than expected. You see, last Friday we had a quote-unquote higher than expected inflation reading, and that's not something that was unheard of, that was higher than expected. I mean, we've been seeing what's been going on with food prices. We've been seeing what's been going on with everything, with energy, with gasoline, just to put into your car. Well, because of that, the inflation is happening faster than what the Federal Reserve had predicted. So that's what they mean there. When that happens, when we have a higher than expected inflation and a Federal Reserve that is looking to fight inflation at all costs, that is a recipe for a downturn in the economy. And so much so that the Federal Reserve, our chairman, Jay Powell, he came out about a month ago now and actually reiterated to Congress, and this is right around the time that he was getting reappointed. He told Congress basically that one of his idols was Paul Volcker back in the 70s, early 80s. And Volcker was known for fighting inflation and not caring about the ramifications to the economy. And so in the late 70s, early 80s, yes, we really destroyed inflation in a meaningful way that we had not done for the previous 10 years, but it also caused a downturn in the economy as well. And that is what Jay Powell has already come out publicly stating that he wants to have happen as well, that he is going to say that the economy is going to be second to inflation. And when we have a higher than expected inflation level, that really gives him more ammunition to say we need to tighten financial conditions more. And that was not what anyone was expecting in Wall Street yesterday, so especially Friday either. And that is why coming into last week even, so a week ago now, we were looking at actually having this being what's called a basing of bonds, the prices of bonds, and that we could really start to be invested heavily into them, whether it was US-based bonds or actually more to the point, international bonds as well. Well, things were starting to change last week. And even though the week prior, it was looking like bonds would be a good opportunity, coming into Thursday, Friday of last week, it was all of a sudden looking like it would not be as big of a kind of a way to trade and to be invested as what it was. And when we received the inflation information on Friday. That was, again, the green light for the Federal Reserve to do even more with tightening our financial system. And that really came through yesterday, that we had a sell-off in the stock market and this massive sell-off in the bond market. Because remember, when we are doing all of this, that increases our interest rate, that increases what we're paying on those bonds, which if you invested into a brand new bond is a good thing. But as yields go up for bonds, the prices go down. And this was one of the largest bond moves in recent memory. The largest bond move in terms of yields since March of 2020. So that is a massive move that has happened. And when those things happen, those are not to be taken lightly. That means, yes, we could have kind of what you call a rally in the stock market, and that may come. I'm going to talk about that here in a second, of opportunities and windfalls, and also risks that are still in the market even today, right now. But when we have these times that we have maybe, say, an increase in the stock market because of being oversold, that's a time right now that we still need to look at reducing our risk even more, because we're not out of the woods yet. And that's what I want to be reiterating, that we are seeing things that are happening that are never befores in history. So just to give you an example here, tomorrow, Wednesday the 15th, well, we have the opportunity to have the VIX expiration. And VIX is a measure of volatility. And what that means is that people bet basically on whether volatility is going to go up or whether it's going to go down. Now, we have a lot of different information that says, how much people are betting on volatility to go up or down, but we don't know how that's going to affect the stock market. Because if volatility goes up, the stock market generally goes down. If volatility goes down, the stock market generally goes up. So it's just one of those relationships. Well, we know that tomorrow is one of the biggest stock option expiration on the VIX that has occurred ever. So it's one of the largest that's going to be occurring tomorrow. So ever is a long time. And if we are among the top couple, like not just top 30 or 50, maybe in the top 10 ever, and we're talking this is only eclipsed by March of 2020, well, then we start to think that there is some massive amounts of money that's going to be shifted tomorrow. Then we also have the actual stock options expiration on Friday. And this again is going to be one of the largest ever. So we're talking well over $500 billion of stock options. And again, stock options are just betting on the way that the stock market's going to go, either up or down. And when we do that, when we have these bets on the stock market, we don't know how the outcome that it's going to be. So there's a lot of reasons and room to think that we could go up in the stock market after our VIX expiration, after the stock options expiration this week, that we may go up, possibly even say 10% on the NASDAQ, maybe 8 to 10% on the S&P 500. Those are not out of the question for these maybe even one-day moves that could happen in the stock market right now. But that just goes to show you that yes, we could be invested to grow and hope that that's actually going to be what happens. But on the flip side, it could go the opposite direction too. We could have these expirations that are coming due that are some of the largest ever actually go the opposite direction, because there's a lot of people that invested a week and a half ago in these basically gambling trading type of vehicles, the VIX and these stock options, that wanted the stock market to go up. And it did coming into last Thursday. And so all of these traders are now again what you call underwater. They may be actually losing money. So what does that do to the stock market? Does it cause it to go up, or does it cause it to go down when all of these expire? That's the reason why right now is a very, very volatile period of time. I see that continuing. I see these huge ramps in the stock market, and I see these huge kind of crashes in the stock market happening all year, just because of the fact that as we start removing stimulus from the markets, from the reserves of the Federal Reserve, the reserves, the money reserves that they have, that causes volatility. That causes kind of like an earthquake type of things to happen, because earthquakes, they have the small little tremors that start, and then we have the big explosions that happen off of that. And as we start reducing the amount of money that's in the system, that causes small little tremors. But here's the kicker. June, right now, is when we're actually doing a huge increase in the amount of stimulus that we're removing. So we're letting a lot of bonds expire. We're letting a lot of money that we had put into the system over the last 2 years be taken away. And we're doing that more and more starting this month. So that alone are causing these tremors to be bigger than what we had seen prior. So we may get more 2, 3, 4% up down days, maybe 5, 6% up days and down days, just because that these tremors of what the Federal Reserve is doing are getting larger, because the money that they're taking out of the system is getting larger. So when things like that happen, it's not a time to be, in the words of millennials now, YOLO, which is YOLO, you only live once. And that was an expression all through 2020 and 2021 that just put every dollar, every dime you have into these stocks that are going to, what they call, go to the moon. So putting all of your money into trying to buy the absolute most amount of stock possible so you get all of the gains. Well, that's a good place to be when the economy is doing well. That's a bad place to be when the economy is not doing well. And at most, when we take a look at these environments, we can get sustained rallies in the stock market. But if indeed we are taking money out of the markets, if we are removing all of these stimulus the way the Federal Reserve is doing, that also means that most likely these are not a sustainable rally. And it could be still, 2, 3, 4 weeks, 5 weeks, 6 weeks. These rallies occur, yes, but they may come right back down. And that's where, again, when things are so unknown as to the direction of the stock market, the way that it could go, that's the reason why we want to just be more risk adverse right now, because we know times are going to get better in the future. We just have to make sure that we protect our capital right now so that we are able to do that and be there when times start getting better. So that was a very long-winded way to say that there's a lot going on, and please feel free to reach out as you have questions, because there's going to be many opportunities. But right now, the unknowns are greater than the knowns, and I've always said this, that when there are unknowns, that causes volatility. But when those unknowns turn into knowns, that provides opportunity. Take care.